Good morning. How are you today? Last video we learned the accounting assumptions. Today we are going to continue the accounting principles and the accounting constraints. The accounting principles are historical cost, objectivity, full disclosure, consistency, revenue recognition, and expenses recognition, matching principle. The accounting constraints are materiality and fair value measurement.
What is the historical cost principle? The acquired assets and services should be recorded at their actual cost at the time of purchase. The cost is a reliable and verifiable measure. It is considered objective. An entity should continue reporting the historical cost of an asset over its useful life. Now look at an example of the historical cost principle. Example. A company pays Rs. 20,000 for a car on August 21, 2019. The market value decreases to Rs. 15,000 at the end of the year. What is the cost that should be recorded by the company? Why? Conclusion. The cost principle requires this purchase be recorded at a cost of Rs. 20,000. The cost is a reliable, verifiable, and an objective measure. We must record it at their actual cost. Second, we will learn about objectivity. What is objectivity? 1. All accounting data must have evidences. 2. Valid and reliable to support transactions occur. 3. The goal is to prevent accountants in giving subjective and inaccurate opinion. Read example for objectivity. What is the important sentence or word from the example? AA Enterprise uses receipts and vouchers as source documents to record cash transactions. However, for cash taken by the owner, there is no document issued. Hence, drawings was not recorded. What do you think? So, what is the conclusion of the above situation? Conclusion. The business does not comply with the concept of objectivity for the drawings. All transactions should have source documents as basis for recording. These documents provides evidences and can facilitate the recording of transactions. Third, what is the principle of full disclosure? The company should report sufficient information, i.e. relevant, reliable, comparable. Usually, the disclosures are in notes to the financial statements. Is the situation below relevant to the principle of full disclosure? AA Enterprise has changed its inventory valuation method. The company did not disclose this information in the financial statements for the accounting period. What do you think?
What is the conclusion? AA Enterprise does not comply with the concept of full disclosure. When a change is made, details of the change should be reported in the notes to the accounts. The aim is to inform the user of changes in the financial statements.
Fourth, consistency. What is consistency? 1. Uses the same accounting principles, methods from year to year. 2. The permit meaningful analysis of trends within a business. Example. A company uses straight line method in depreciating its fixed asset. It decides to change to declining balance method. Conclusion. It does not follow the rules of the consistency because the depreciation method should be used from year to year. Any changes should be disclosed in the notes to the financial statements.
The next accounting principles is the revenue recognition. This principle mainly concerns on determining an appropriate period to recognize revenue. Revenue is recognized in the period they are earned. When ownership of merchandises has been transferred to the buyer or when services are rendered. The criteria for the principal recognition revenue are: 1. There is a change of ownership, title. 2. Buyers are willing to pay. 3. The stability of the currency. 4. Buyers are able to pay. Based on the situation in the example, Ahmad sells pottery. He received an order for 100 porcelain vases on January 1, 2020 and received a total payment of Rm 1,000. Goods delivered to buyers on the 15th of January 2020. When should sales be recognized? Give your opinion. Conclusion. Ahmad needs to recognize the sale proceeds of Rm 1,000 on the 15th of January 2020 due to the change of ownership of the goods on that date. The last accounting principles we will learn are expenses recognition or matching principle. Its main concern is to report the expenses incurred in the same period as if the revenue is actually earned as a result of this expenses. This principle helps business to determine the profit or loss incurred for the period by deducting the related expenses from the revenue earned in the same period. Expenses are recorded in the accounting period in which it has been involved to generate revenue. Expenses are recognized when they are incurred even if payment has not been made. To report the actual amount of revenue and expenditure for a financial period. What do you think based on the example below and why? Example. Tini has recorded expenses of Rm 3,000 for utility used by her business in December 2019, although the payment for the utility will only made in January 2020. What do you think? Conclusion. Tini follows to the concept of expense recognition and expenses of the period should be recorded in accounting period it incurred. There are two accounting constraints. Both constraints are discussed below. 1. Materiality. This concept requires business to account only for the items that are deemed significant for a given size of operation. Thus, accountant can ignore and exclude all the items or transaction, which give insignificant effect on the financial statement, or can be concluded. Materiality relates to an item's impact on a firm's overall financial condition and operations. An item is material when it is likely to influence the decision of a reasonably prudent investor or creditor. To determine the materiality of an amount, an accountant looks at its importance and its relative size. Compare it with such items as total assets, total liabilities and net income. Based on the situation in the example, a company purchases a calculator at a cost Rm 20 and it will depreciate for 5 years over its useful life. Give your opinion. Conclusion. Although proper accounting would depreciate the calculator over its useful life, but relatively to the size of total assets the cost of Rm 20 is considered not important. The amount will not make a material difference on total assets and net income. As such, the Rm 20 calculator should be charged to the current accounting period only and not being depreciated for 5 years. 2. Fair value measurement. What is fair value measurement? Fair value measurement states that assets and liabilities should be reported at fair value when it comes to the point of selling assets or settling liabilities. FAS number 157 defines fair value as the price that would be received to sell an asset or paid to transfer a liability, that is, the exit price, in an orderly transaction between market participants at the measurement date. What is double entry system? Accounting uses the double entry system, which means that we record the dual effects of each transaction. As a result, every transaction affects at least two accounts. It would be incomplete to record only the giving side, or only the receiving side, of a transaction. Questions. Discuss the accounting principles involved and why. 1. Market value of machine is Rm 10,000 and original cost is Rm 7,000. What is the cost that should be recorded by the company? 2. The company must report any information necessary for decision-making should be included in the notes to account at financial statement. 3. What is double entry system? Conclusion. We have finished learning Chapter 2. It is expected that students can describe the accounting concepts, that are historical cost, objectivity, full disclosure, consistency, revenue recognition, expense recognition, materiality and fair value measurement, and also can explain the double entry system. All students must be ready for Chapter 3 accounting cycle for next lesson.
Thank you and see you again in the next video.